Well, nice to have you with us this morning. Boy, we've got a lot of monetary policy commentary to work into the market equation on this Thursday morning. And some days it feels like interest rate bingo because I think we're getting a reminder that central banks have to take action, but they don't have all the answers. And yesterday you saw Jay Powell, the head of the U.S. Federal Reserve, deliver on what many thought he would do, which was to take a breather, take a pause on interest rates. But what exactly does that mean when there was also messaging that we might, as soon as we've seen a pause, get back on the rate hike train? But I think living here in Canada, you know that story. We know that the Bank of Canada earlier this year said, well, we've done a lot of rate hikes, and obviously we're making progress on inflation, but we're not quite there, and there are some risks to the economy, so we're going to take a pause. And then, of course, the inflation numbers forced the Bank of Canada back into rate hiking mode. And then you've got these other storylines like the ECB this morning, which is still with some pretty hawkish commentary. They raised rates again, indicated they are not done. And yet you've got China on the other side of the world, which, a lot of people have been talking about the recovery story in China not being as robust as some had thought. And we are seeing loosening monetary policy there. Now, let's just get back to the markets more broadly speaking. I know that the TSX isn't in bull market territory based on the run-up off the lows, but the S&P 500 is. And the Bloomberg intelligence team has been looking back at history at what happens when you enter a pause period. Now, they actually found 6 instances since 1970 when you have a pause in rate hikes, and over that period, on average, you tend to see really good performance for the stock market. The problem with this current environment is, I mentioned, it's a pause with the caveat that rates might go right up again. And Bloomberg crunched the numbers. They found just a couple historical examples where you had basically a 1-month pause of late tightening cycle pauses. There was one in 1989. Markets were up more than 4% 3 months later. But after the 2000 pause, stocks were down 1.5%. So I'm not sure we can reach any consensus on that just from a couple of stats, but we got to try. Let's have a deeper conversation on all of this. JoAnne Feeney, who consulted the Fed and the IMF and these days manages money and watches these stock markets daily, is a partner and portfolio manager at Advisors Capital Management. She's been kind enough to join us. JoAnne, nice to see you.
Hey, good morning, John. Certainly has been an active couple of weeks.
It has. Okay, so how are investors supposed to make sense of, I guess, what we're describing a hawkish pause?
Yeah, the easiest way to think about this is that inflation is still too high, and it's going to be too high for a while. And the Fed is doing 2 things. One, it's pausing to recognize that it's already raised rates quite a lot, and it understands that there are long lags to the change in interest rate and to the effect on demand, whether it's from households or from firms, and it wants to see how those play through. But secondly, it also made it very clear that inflation is still too high, and it's going to take years for it to come back to the 2% target. And that might very well require it to raise nominal interest rates, the federal funds rate, a little bit further, maybe 2 more rate hikes this year. And that comes in pretty stark contrast to what the market was hoping and pricing in the United States, which was a cut to rates later this year. So the Fed's been trying to tell people, no, don't expect us to cut. And this time they just made it very, very clear that that's not going to happen anytime soon.
And, we like, very distinct paths on whether we should buy or sell in the market. I don't blame anyone for that. I think a lot of historical charts show us that when you see all of a sudden rates start to come down, historically that has been quite an opportunity to step back into stocks. But you just outlined a scenario which is a little bit muddy. So what is your take on what happens in the equity markets? Just I guess the other caveat is we've been talking endlessly about this.
Yeah, so the equity market, particularly in the U.S., is really a tale of 2 markets. That's beginning to change slightly now, but we had, this surge in very specific technology and consumer stocks over the last 6 months that was related to companies that really had multi-year growth opportunities. And a lot of it was tied to AI, generative AI with Nvidia and some of the other companies, but also companies that had really gotten pulled down in their valuations with the rise in interest rates over the previous 18 months that had that chance to come back, whether it was Apple or Meta or something like it. So that was one part of the market this year. And so when you call the S&P a bull market, really it was driven by a handful of stocks. We're starting to see a broader enthusiasm come back now, although it's taking a pause today as investors digest the fact that interest rates are going to stay higher for longer. We've always had that view that interest rates are going to stay higher for longer, that the Fed has a lot of work to do. Nevertheless, we still see a lot of equities as really attractive. We were in and stayed in a lot of those technology names, and that helped our clients, but also some other areas where there's secular growth, like housing. We talked on this show, John, about Lennar in the past. They reported last night. They increased their forecast for the year. They're seeing continued strong demand after house buyers digested the fact that mortgage rates are going to be a bit higher for quite a long time. They still need to go out and own a house. And that's a structural demand that we think is going to be around for many years. So there's still places to invest despite the higher interest rate environment.
I want to give you a nod, JoAnne, because you have been talking about those stocks for a while. I do tend to discount the narrative that it is just some tech stocks, because there are a couple other groups, including the home builders, that have had quite a move off last year's lows. You've talked about them. And you were one of the unique guests who was leaning into some technology companies. We had a list for our TV audience, just names like Broadcom. But you've been talking about that stock for a long time. And coming into this year, there weren't a lot of people who were saying go big on growth after feeling a bit scarred last year.
Yeah, I think people perhaps digested the impact of higher interest rates on valuations. Clearly that had an effect, but what we were trying to explain to people is that that's a one-time effect. Ultimately, what's going to drive the valuations of growth companies is the growth that they actually deliver in earnings. And what we've seen over the past 6 months or so is investors really recognize that a lot of these companies are going to deliver growth far better than the market on average, and that people need to own them, whether it's cloud computing, the latest thing being the AI thing, but that's all part of a bigger move towards more sensors in the economy, more data, more video, more demand for the internet, and all of the hardware you need to make that all work. Cars that are smarter, forget about self-driving, just smarter, just safer, right? All of that leads to higher demand for the software, the security, and the hardware that makes it all work. And so there's just real growth there, and it's hard to find that growth elsewhere. Housing, though, we still continue to like. But you've got to look long and hard to find growth in the global economy right now, and those are a couple of good places to find it.
Okay.